Hello and welcome again. This is Christopher Aaron coming to you from iGoldAdvisor.com. It's August 30th, 2015, and today we are looking at gold versus the gold miners. Here we have a chart of gold going back 35 years. This will be familiar to anyone who saw the last presentation. Just to summarize that, I do believe that there is a distinct possibility for another down leg in the gold bull market that would take us to somewhere in this 850 to 1000 region. That may or may not happen. It's possible that the low is in already. But either way, when we move on to the gold miners, we're looking here at a chart of the XAU index from the last 31 years. What's really significant about this is that the gold miners here are priced at roughly the same level as they were in 2001 when gold, to back up, was down here around $250 an ounce. Why is that? Well, there's a lot of theories as to why. The ultimate answer is no one knows. No one has the ultimate truth as to what a market is doing, but some of the reasons that are given by the mainstream media include production costs being too high, debt being excessive, shareholder dilution, and all these things probably play a role. But the point is that you have a market here that for whatever reason is down here at basically its 31-year lows, while you have the product that they produce up here having broken out still from a 30-year consolidation and still above those highs. So one way to look at it would be to say that we expect gold to come back down to a level matching this region, which would be roughly $200 or $300 an ounce. And the other way to look at it would be to say that there's an anomaly occurring and that anomalies don't last for long in markets before they correct themselves, and that there's a chance that this XAU index of gold miners is going to play catch up and come back in here to the resistance zone that it tried to break out of several times over the last 5 years or so. Now, the XAU index looks a lot like this chart from the Dow from 1959 to 1982, where you had a lot of back and forth action, including some major swing downs and swings up that lasted these 20 some odd years. And we know that after this multi-decade consolidation, you had a multi-decade advance that rose roughly 1,000% from that previous all-time high here around 1,000. So just to look again at the XAU index, this is a pretty similar looking chart to me as far as the back and forth action, the defined support, defined resistance zone, and the fact that you've here had a really severe down leg going lower than this last one in 2008. And when we compare that to this Dow consolidation, in my mind that is similar to this correction that we had here in 74, where you came below this 1970 level, only to rebound within the next year and to continue another 5 or so years of consolidation until that breakout. So I see this as a distinct possibility for the XAU index that it is going to play catch up at some point in the next 5 or so years. That being said, right now we have a situation where, plotted on a ratio, the XAU index to gold ratio is at an all-time low as far as my data shows. And at this level, as this ratio approaches 0.1, we expect many gold miners here to be declaring bankruptcy. There's a number of them that are approaching that, and you can see that in the charts, and the fundamental news matches that. Now, interestingly, we do have, from a technical standpoint, a bullish falling wedge here, shown in blue, which goes back basically for the last 15 years, that is approaching a resolution. Now, this ratio cannot go too much lower. I mean, we've moved from 0.08 to 0.04 over the last year. So, for example, another move from 0.04 down the same amount would take us, as far as a percentage-wise goes, would take us to 0.02. Well, you can't go lower than 0 on this ratio, because that means the entire sector of gold miners is going bankrupt. And since this is at a historic anomaly here, I think you're really looking at a very a very distinct occasion here that's happened in these markets. And for those who have cash on the sidelines, this may represent a unique buying opportunity as this ratio reverts to more of a historic norm. For example, if this ratio were to get back to 0.2 from 0.04 at today's gold prices, with no rise in the price of gold whatsoever, you would have roughly a 400% gain. So that's a possibility that is worth at least considering, that there could be a lot of outperformance here to occur. Again, not this week or next week. This bullish wedge pattern still has to resolve, and that could take another year or another 18 months. So this is really for a long-term outlook that we're talking about here, that once this resolves, you may have some serious outperformance happening over the next 3 to 5 years. And how does that look, this ratio? How does this play out as far as an individual company example? Here's Harmony Gold Mining. Stock, it closed a few days ago at 91 cents a share, down from 15. So that's a 93% drop or so. And you can see here the relative strength being very poor versus that HUI index. Underperforming even the HUI by a significant amount. The HUI, which itself has been in a bear market. So you can see this is one of the poorest of the poor as far as the gold miners go. And as I said before, those are the ones that have a distinct possibility of declaring bankruptcy here in the next 18 months. Now, all that said, I think this represents a very interesting time period to be looking at these relative strength indicators for anyone who is looking to start accumulating a position in the gold mining sector. This could really represent a fantastic opportunity. And I want to give a couple of examples of using relative strength from 2008, during the crash of 2008. And let me get right into that now, because this is what's possible using a relative strength analysis during a crash. For example, here's the S&P 500 from 2007 to 2009. Obviously, this top in 2007, major crash in 2008, an initial low in November of 2008, followed by the final low here in March 2009. For example, a company like Citibank, here over the same exact time frame, falling from $450 a share down to $20, that represents a declining relative strength versus that S&P index. So in other words, the S&P index lost a lot of value, but Citibank lost even more value relative to the S&P 500. Now, in comparison, here's the same time frame for a stock like Amazon, where you had a very distinct pattern here happening in this time period where the S&P 500 was making a lower low. Remember, we'll go back here. The final low in March of 2009 occurred here around 700 in the S&P 500. And notice it was lower than the November low. Take a look here at Amazon, and Amazon was higher than it was in November. And that's what shows up here as a relative strength indicator. So what this means from a fundamental standpoint, this is really, really significant. Um, it means that inside investors, or smart money, as some people may call it, or strong hands, as is often referenced, these inside buyers here, as the general stock market was crashing to a new low in March of 2009, they were not selling Amazon stock. So they were selling everything except Amazon stock, for example, and a few others. And that's why Amazon did not make a new low. And in fact, there were people buying Amazon as they were selling the broad stock market. So when that kind of outperformance happens during a crash in the overall market, it's very significant because it indicates that there's something special happening with this stock, in this case Amazon, compared to the stocks that are not being accumulated, such as Citibank, which continued to make new lows here into 2009. So to see how this played out, here's Citibank, where there was poor relative strength. It basically did not recover from this crash. You had somewhat of a percentage gain here from the absolute lows, but as far as a recovery from the 2008 crash, basically non-existent. So that's for a company that showed poor relative strength during the decline. What about a company like Amazon? Well, here you can see that decline into 2008, 2009. And here's the performance in the last 6 years. You've had roughly a 1,000% gain from these lows, around below $50 a share, more than 1,000% gain. You're right above 500 these days. And this is a significant difference. Just to back up one more time, Citibank recovery, Amazon recovery. The way that we can see these potentials, these candidates, is by looking at the relative strength indicator as the crash is occurring. And that's the real key time, is to look at which stocks are not being thrown out with the bathwater, as they say. Now, the easy money has been made here in Amazon, so we need to turn our attention as private investors to the next market that looks like it's bottoming and that stands a decent chance of recovery over the next 5 years. And from my analysis, that happens to be the gold mining sector. Here is the gold mining sector, again shown this time by the HUI index, which is similar to the XAU index, but it's actually a stronger index as far as its performance. It includes the gold companies that do not hedge their production forward, but sell it for market prices, whereas some of the companies in the XAU index do hedge their prices forward. So in other words, the companies in the HUI are one of the purest plays that you can make as to companies that are selling their gold for the true market price. And here's just a look at the last 6 years or so. Again, the October 2008 low, the recovery, the top, a bear market, and now what I believe to be is a long bottoming process that is in play right now. Shown here by the November and the August lows from the last year. Now, here you have an example of a company that is showing this positive relative strength compared to that HUI index. Here you have a 2014 and a 2015 low that are even, whereas to go back, the HUI index, the 2015 low was lower than the 2014 low. Even more importantly, both of these lows are significantly above that 2008 low, whereas look at the HUI index again. both of these lows are below this 2008 low. At least this most recent low is, the 2014 low being roughly even. So whereas the HUI index of gold mining stocks has declined below the 2008 lows, Randgold Resources has not. So it's showing this relative strength here. And bring that back to the example of Amazon. Amazon was a company that was not making new lows in the S&P 500 bear market into 2009, whereas the rest of the sector, the rest of the stock market was. Here you have a company that is not making new lows even as the HUI index is. And this is very, very important. This is showing us that insiders are not selling this company even though they are selling other ones. And there's an example again. There's Harmony. We showed this chart earlier of a company that is declining not only with the HUI index but more so. So this would be a company that, if you were to have paid attention here as it was breaking down below the 2008 lows, you would have said, okay, this one's breaking down, whereas Randgold Resources is not. Something's wrong with this company. And when a major New York Stock Exchange traded company gets down here below $2, especially below $1 a share, that's telling you there's some major operational issues here going forward. So just to summarize here, guys, for people who are first looking at the gold market, I would say that this is a very interesting time to be following this market. I do not recommend that you jump all in at once. I do not recommend placing all your assets in gold or gold-related items. But there is an historical anomaly happening right now where the valuations of these mining companies are severely depressed relative to the valuation of the commodity itself. And that may indicate that there is some outperformance ready to happen over the next 5 years or so. And for people who are looking at that and saying from a risk to reward standpoint, maybe it makes some sense to place some money into a basket of gold mining companies, I would tell you to look very carefully for those companies that are performing strongly on a relative strength indicator, because that's how we pick the Amazons versus the Citibanks as that example. So just to conclude, I have a report that I am giving away for free right now on my website, iGoldAdvisor.com, and I've basically scoured the HUI, the XAU, and the GDX index for relative strength indicators from all those stocks, about 55 total stocks. And I've selected the top 5 relative strength large cap gold miners in all those indices. And I am releasing that as a free report for listeners and subscribers right now. All you have to do is go to my website and click on that link right now if you'd like it. In the future, I'll be producing reports that'll be paid reports on some of the mid-tier and smaller companies that have a greater risk and a greater reward ratio. But I thought I would release this for people who are new to the market, because typically the large cap gold miners are the safest ones, and they're typically the ones that will move first as a bull market emerges. So what I'm advising people is that if they're looking to accumulate a portfolio in the gold mining sector, that they should probably look at a basket of at least 5 of these miners to invest in. So that's why I'm releasing this report. Again, it's free, and feel free to download that or not. Either way, thanks for joining me, and I'll see you guys next time.